Fiat will be priced in Bitcoin by Greg Foss. We then extend the analysis to determine why Bitcoin is in fact a very valuable exotic option. Moreover, as an exotic option with no term, there is no time decay on your long volatility position. Before we can truly comprehend why Bitcoin may be the perfect option instrument, we must first go over a little options theory. This will help us more easily grasp the concept of Bitcoin as a long put option on the fiat Ponzi. In the most simplistic form, an option is a derivative that derives its price from its underlying asset. An insurance contract is very similar to an options contract and is a great starting point for understanding options. With any options/insurance contract, you have two parties looking to achieve different outcomes. For instance, with house insurance, you have the buyer, who is looking to pay a premium upfront to obtain monetary protection in the event of a fire, flood, or any other adverse event. The seller, who is looking to obtain cash flow upfront and believes that the probability of payout due to an adverse event is less than the premium received from the buyer as a buyer of an option. You would say that you are long the option. And as a seller, you would say that you are short the option. With that being said, we will circle back once or twice to the house insurance example, as it's a good analogy for trying to grasp the mechanics of a long put option. In the house insurance example, the underlying assets would be the house and the premium paid for the insurance is based upon, as well as things like how long you are looking to insure your house. How is Bitcoin a long put option? Although Bitcoin isn't technically an option, one of the main narratives behind its rapid growth since inception is that Bitcoin is effectively an insurance contract in the event that the fiat currency system were to become immersed in a credit deterioration that includes many eventual failures. With that in mind, you could liken buying Bitcoin to buying a put option on the fiat system. If we were to see a failure of the fiat system, Bitcoin will most likely disproportionately benefit. However, Bitcoin is unique as it comes with many of the upsides of an option without some of the traditional downsides, which we will get into. When analyzing an option, different options provide benefits under different conditions. You can determine what conditions impact an option's price by studying what are called the option Greeks. These metrics help you determine an option's sensitivity to a multitude of factors, such as time, volatility, interest rates, etc. With that said, we will dig into four of the more well-known Greeks: theta, vega, gamma, and rho. Theta measures an option's change in price as we pass through time. Bitcoin is theta neutral. One of the major downsides to being an option buyer, long the option, is that you are confined by a time limit. When you initiate an options contract, you set an expiration date for when this contract will expire. At this predefined expiration date, you no longer have insurance/protection against the adverse event you initially paid for. In the options world, this creates something called theta decay, which means that as time moves closer to expiration, your option decays in value as there is a decreased amount of time for an adverse event to happen. This is why the longer you are looking to insure something, the more costly it'll be. Although Bitcoin has many of the same benefits as a long option, Bitcoin is unique in that it is not a time-constrained contract, it is its own asset. Ultimately, as Bitcoin is not time-constrained, there is no loss of value over time due to theta decay. By owning and holding Bitcoin, you have an indefinite immutable insurance contract that will reward you greatly in the event of a significant collapse of the fiat system. Vega measures an option's sensitivity to an increase or decrease in volatility. Bitcoin is long Vega. If someone says they are long an option, that means they benefit from disorder and increased volatility. In our house example, if our house were to burn down, our insurance policy would pay out. We are benefiting from increased disorder and volatility. How does this relate to Bitcoin? With Bitcoin being a long put option on fiat, which is built upon debt, being long Bitcoin means you are essentially short credit and benefit from disorder and volatility in the credit markets, with greater monetary and fiscal intervention causing an increase in the money supply and debt burden. While decreasing the dollar's purchasing power, we see greater economic instability. With greater instability comes greater uncertainty for the security of the dollar and the looming debt burden. This uncertainty leads to greater volatility and disorder. As Bitcoin is a long put option on fiat and credit, it benefits from increased volatility and uncertainty. Gamma measures the rate of change of delta. Bitcoin is long gamma. In the options world, gamma is a measure of something called convexity. More specifically, when you are long an option, you are exposed to something magical called positive convexity. In financial jargon, this is the non-linear return profile of the option. In percentage terms, this is a 3,000% increase. This non-linear return profile or asymmetry in upside potential is called positive convexity. It is a risk manager's dream, as you can hedge your portfolio with a small allocation to Bitcoin, while also gaining exposure to outsized returns. Over time, as we see further monetary expansion and the suppression of interest rates in order to quell the looming debt burden, more and more assets will start to lag inflation. Rough estimates put global assets, excluding derivatives, at $532 trillion. As investors look to exit these poorly performing assets and move to greener pastures, Bitcoin is in prime position to benefit, and due to the long gamma exposure explained above, the upside potential is unchallenged. Rho measures an option's sensitivity to a change in interest rates. Bitcoin is both long and short Rho. Bitcoin is unique in that it is one of the few assets that can benefit regardless of the direction interest rates move. Due to the excessive debt burden in most countries, if interest rates start to rise, people will no longer be able to service their debt payments. Contagion will increase, leading to a quickening of the collapse of the current financial system. This will increase the number of traditional asset holders looking to exit their positions in search of assets that offer them protection with no counterparty risk, such as Bitcoin. On the other hand, if rates start to decrease, borrowing costs decrease, which encourages debt consumption and spending, increasing inflation and the availability of capital in the economy. In this event, we would see the purchasing power of the dollar collapse. This would push smart money out of the risk curve into positions that hedge their portfolios against this collapse of purchasing power. We're better to protect purchasing power than in Bitcoin. Bringing it back to the Greeks, as Rho measures an option's sensitivity to interest rates, Bitcoin benefits regardless of the direction that rates move. Now that we have the option Greeks out of the way, and we have laid out the framework for Bitcoin as a long put option, what should be evident is Bitcoin's unique properties as an exotic option. In Part 2, we will look at why Bitcoin may be the perfect option instrument. Bitcoin is a long-volatility position. Foss has stated in previous research that Bitcoin is akin to owning credit insurance on a basket of sovereign issuers. He has calculated an intrinsic value for BTC using sovereign credit default swap, CDS, spreads, and shared it with Bitcoin Magazine here. It is important for readers to understand that when you own credit insurance, you are short credit and thus you are long volatility. When credit conditions are worsening, reflected by increasing credit spreads and reduced lending confidence, the knock-on effects always result in equity markets being dragged lower and at a faster pace. This results in a reach for equity option, insurance, or protection, and as such, the VIX index increases in lockstep. If credit conditions continue to deteriorate and the VIX exceeds 25% annualized volatility for an extended period of time, it has been Foss experience that new issue markets shut down and financial conditions worsen. In other words, the contagion continues to bleed into other markets. Remember, credit is the dog and equity is the tail. Due to the priority of claim and credit relative to equities, if the creditworthiness of the debt becomes a concern, a credit trader can always hedge their risk using a short position in the subordinate claim. The equity credit markets are also far larger than equity markets. There is no question that the current level of understanding of most Bitcoin investors is that Bitcoin performance is directly correlated to equity markets.